Hey everyone, and welcome. So, you're ready to start investing, right? You hear all the buzz about stocks, big returns, and you're thinking, I need to get in on that. And honestly, I get it. But what if I told you that jumping into profits without building a solid foundation first is one of the single biggest financial mistakes you could ever make? Today, we're going to talk about why building your financial fortress before you attack is the real secret to lasting wealth. So let's just cut right to the chase with the most important question. What should you focus on first? Building wealth or creating security? Most people get this completely backwards. They think security is something they'll deal with later, once they're rich. But as we're about to see, that is a seriously dangerous way to think.
Think about it like this. Your financial life is this giant, gleaming skyscraper. Your investments, the stocks, the mutual funds, those are the fancy penthouses at the top. But what happens if that whole beautiful structure is built on sand with no solid foundation? The first storm that rolls in and the whole thing comes crashing down. That foundation, that solid rock underneath everything, well, that's your financial protection.
And look, this isn't just some abstract theory. This is a very real, very critical issue, especially in the Indian context. There are unique social and economic factors here that create financial risks most of us just don't see coming until it's way too late. Let's dig into what those are.
Just look at this chart for a second. The gap is absolutely massive. We all know about general inflation, right? Things getting more expensive by, say, 6% a year. But healthcare inflation, that is on a whole other planet. It's soaring at 15 to 20% every single year. A single unexpected medical emergency can literally wipe out a family's entire life savings. It's that serious. And then you've got the job market. The numbers here are just staggering. Only about 10% of the entire workforce is in what we'd call the organized sector, with safety nets like a provident fund. The other 90%, they're in the informal or gig economy with basically zero safety net. For 9 out of 10 people, losing your income isn't a what if, it's a constant, very real threat. So how do you even begin to build a fortress against threats like these? Well, you start with your very first line of defense. You dig a moat. We call this your emergency fund, and its only job is to stop those immediate threats from ever getting close to your castle walls. Now, let's be super clear about what this fund is for. It is not for a vacation. It's not for a down payment on a car. This is your break glass in case of emergency money, for real. It's for true life-altering events, suddenly losing your job, a medical crisis that your insurance doesn't quite cover, or a massive urgent home repair you simply can't put off. So, how much money are we talking about? Well, there's no magic number. The size of your moat really depends on your personal risk level. If you're the only one earning in your family or you work in a pretty unstable industry, you need a bigger buffer for sure. Think 6 to 12 months of your essential living costs. But if you're in a stable, dual income household, maybe 3 to 6 months is enough. You just have to be honest with yourself about your situation. Okay, now this is a really clever way to set up your fund so it's not just sitting there doing nothing. You don't just dump it all into a savings account. You ladder it. So, step 1, keep 1 month's worth of expenses in your regular savings account. You can get to it instantly. Step 2, put the next 2 or 3 months' worth into liquid funds, where you can get the money out in about a day. And the rest, that can go into slightly higher yield options like ultra short-term funds. It's the perfect balance between being ready for anything and still letting your money work a little for you. All right, we've dug the moat. Now it's time to build the walls. If the emergency fund is your first defense, then insurance is the massive stone shield wall around your fortress. This is what protects you from those catastrophic attacks, the ones that can flatten everything you've built in an instant. And listen, just like a real castle, one thin wall is never enough. You need layers. You need term life insurance to protect your family's income if you're gone. For health insurance, you need 2 parts, a base policy for everyday stuff and a super top-up that kicks in for those huge, scary hospital bills. And then there are the 2 shields almost everyone overlooks, critical illness cover and disability cover, which protects your single most valuable asset, your ability to earn a living. Want a really quick rule of thumb to see if your main wall is strong enough? Your term life insurance cover should be at least 10 to 15 times your annual income. That sounds like a lot, but that's the amount that ensures your family can actually maintain their lifestyle and hit their goals, not just pay off a few debts. I know this can all sound a bit theoretical. So, to make it really hit home, let's look at a real-world example. Let's talk about the Sharma family and see what happens when a fortress like this comes under attack and the defenses just aren't strong enough. It is genuinely frightening how fast things can unravel. Month 1, a medical diagnosis. Their insurance was too small, leaving a 3 lakh rupee gap. That instantly wiped out their emergency fund. Poof, gone. By month 2, their household income is cut in half. By month 3, they're borrowing from family. By month 4, they're racking up high-interest credit card debt just to keep the lights on. One single event created this devastating financial spiral.
And this slide? This is the whole point. The crisis was the same medical event, but the outcome? It could have been completely different. With a properly built fortress, with a bigger emergency fund, better health insurance, maybe a critical illness policy, the Sharmas would have weathered that storm. Their long-term goals would still be on track, and most importantly, their peace of mind would be intact.
Okay, that story is a cautionary tale for sure. But this isn't about making you feel scared. It's about making you feel prepared. So let's pivot and talk about your blueprint for building a resilient fortress, one that lets you go from just surviving to actually thriving.
So often, we look at protection as just another expense. It's time to reframe that thinking. It's an investment. Look at this example. A really solid protection plan might cost about 1 lakh rupees a year, but what does that investment buy you? It buys you the avoidance of 10, maybe 20 lakhs in crippling debt. It buys you unbreakable stability. I mean, what an incredible return on investment that is.
So here it is, your action plan. This is the blueprint. First, build that moat, 6 to 12 months of expenses. Second, erect that wall, 10 to 15 times your income in term life insurance. Third, add the layered health shield. Fourth, reinforce everything with critical illness and disability cover. And last, and this is so important, inspect your fortress every single year. Make sure it's still strong enough for wherever you are in life.
And that's the question I really want to leave you with today. It's not a matter of if a financial storm will come, but when. So take a hard, honest look at your own finances. Is your foundation made of solid rock, or are you building on sand? Because the time to build your fortress is now, when the sun is shining long before you ever see a storm cloud on the horizon.